Hey folks, welcome to a product review at Finominal. Today we're going to look at AQR's long-short equity fund that trades under the ticker QLEIX. Now, the fund has been around for more than a decade and it aims to provide exposure to value, momentum, and quality stocks in a long-short equity format. Now, let's explore if the fund has been doing what it's supposed to do, and we're going to validate that via a returns-based factor exposure analysis. Now, let's kick off with actually asset class exposures first. And what we do see is that the exposure to equities or the S&P 500 has been consistently positive, but also time varying in nature. We do see the exposure to other asset classes like bonds and US dollar index and commodities has been low. And that's kind of like what we expect from this kind of like fund. Now, moving to equity factors, what we do see is consistently positive exposure to the value fund, also to quality, more or less, and momentum. We do see that the exposure to the low volatility factor kind of hovers around zero over time, and that there is almost consistently negative exposure to the size factor. And that is simply explained by AQR preferring to use mid and large caps in portfolio construction rather than small caps. The portfolio of QLEIX is constructed effectively by combining 1,000 stocks on the long side and 1,000 stocks on the short side. It's not market neutral, as mentioned, and we can actually visualize that via kind of like the alpha attribution, where we do see that in some years, the S&P 500, by the dark blue line, contributed significantly. Having said that, what we also do need to point out is that the R squared of this regression is on the low side. And so we can have a discount some of those stats. Now, this is with regards to QLEIX in terms of its factor exposure. So it is doing what we expected to do, i.e. provide exposure to value, quality, momentum stocks. Now, let's have a look how that fund would have done for investors in terms of diversification, because that's kind of like the key reason why you would allocate to this. And we're going to use our diversification booster tool for this. Now, what we do see is that the correlation to stocks is high, 0.59 over the last 11 years. Having said that, we still do see that if you have a portfolio comprised of the S&P 500 and you would have allocated 25% to QLEIX, the Sharpe ratio would have increased significantly. Now, we do see that effectively the return would have slightly gone down, but so would have the drawdown and volatility, therefore increasing to high risk adjusted returns, which makes it attractive. What's kind of interesting to see is that the correlation to the S&P 500, or you can also look at the beta, has been kind of like declining over the last 2-3 years. So nowadays it is perhaps a more conservative instrument. There's certainly more exposure to factors than the stock market, which used to dominate returns. And it's kind of like interesting to think about in terms of how AQR actually does that, in terms of what makes them decide to have a high allocation to equities or a low one. Now, that's from this product on a standalone basis. And as mentioned, from a Sharpe perspective, like this did create value. The issue that we have with this product is effectively that it's a combination of equities and factor exposures. And we would always prefer to have simpler, cleaner strategies, i.e. just have the factor exposures rather than this combination. Simply because it's difficult to think about how to allocate this product. Most investors have exposure to equities, and then if you add a fund that has exposure to equities again, you have duplicate risk exposures. And in this case, actually, there's no need to do so, simply because we can replicate QLEIX with another product from AQR. And so what I've simply done is created a replication portfolio that has just two components. One is the S&P 500, where we allocated 50%, and another product from AQR, which is QMNIX. And this is effectively the market neutral version of QLEIX. And that's much cleaner because there's no equity in here. And so just to prove that, like these, that we can replicate QLEIX. So let's take this here and let's add QLEIX. So effectively what we see is that the trends in performance were almost identical. The total return since 2015 is almost the same. As mentioned, the simple replication is just 50% to QMNIX, 50% to S&P 500. Now, most investors already have the S&P 500 portfolio. So instead of allocating to QLEIX, they can simply allocate to instead of allocating to QLEIX, they can simply allocate to QMNIX. And that makes asset allocation much simpler because you already have equities. You want this long short factor exposure from AQR, which is great, right? And you add that via QMNIX. And that kind of summarizes our product review of QLEIX in the sense that it is a product that has created diversification benefits for investors. It does what it is expected to do in the sense of providing exposure to value, momentum, quality stocks. Having said that, from an asset allocation, we have preference for just market neutral factor exposure. AQR offers a product for that. So, go for that. Hope that helps. Have a nice day.